good morning. Welcome to the Capital Grounds podcast. I'm Nick Miller. I've got my co-host here, Joe Fisher. We're with SITG Capital. We're a real estate investment firm based out of Texas currently. And we're here to bring you news about real estate, talk to you about some topics. And if you're looking to get into real estate investing, we're going to talk about a number of things you may find interesting today. Some stories about how we got into real estate investing and some of the drivers we hear other people have that got them into real estate investing. But Joe, how are you this morning?
Nick, doing good. How are you doing?
I'm doing well. I'm doing well.
Good,
Beautiful
good.
spring day here in Kansas. I think we're going to get up to 85 today, 85 and windy.
Hey,
That's good.
well, it's Kansas, so it's always windy, right?
Always windy. Always windy.
Yeah, I think we're similar down here in Dallas. We're gonna be low 80s today, a little overcast. So pretty nice day. I'll take it. Nick, where are you at today?
I've been relegated to the basement.
Ah,
Relegated to the basement for the time being. So change of scenery. Yeah, glad you noticed. Glad you noticed. But Joe, we've had some interesting things happen in the last couple of weeks. Got rate
we
increases.
have.
We've had some changes. I saw some interesting news this morning. Want to dig in and just talk a little bit about that. I heard a quote by the Deputy Assistant Secretary of the U.S. Department of Housing and Urban Development, Ethan Handelman. Handelman,
Mhm.
not sure how to pronounce his name. Anyway, the quote is, "You often see new housing branded as luxury, in part because it's new. When you get to affordable housing, we need to be providing some additional capital and or rental assistance to make that housing affordable to the people who need it most." And I think that's uh, from our perspective, certainly, very obvious, but uh, I want to take a couple of moments to talk about why. Why is it that everything we build for luxury? Joe, I've got some
Yeah,
thoughts, but would love to hear yours.
yeah, for sure. And this is actually a pretty good CNBC article. It's short, so it'll be a really quick read for you guys, and we'll highlight the majority of it here because I got a couple other points in there that I want to go over. But I think he brings up a good point there, and I think there's some challenges, right? And we've seen some of those challenges kind of get amplified because of COVID. Um, but one reason is workforce housing, which we do have a lot of, our partners have a lot of. So it'd be like Class C, um, is a lot more difficult to get loans for right now. So it's a lot harder to go out to the market and find somebody who's willing to loan you the money to buy a Class C property. They deem them as riskier, right? I mean, rightfully so. They are older buildings, typically, you're talking maybe built 60s, 70s, up to 80s. And so you're going to have more problems with them. They're typically not in the greatest areas, right? Because those areas have changed over time. So I think the number one reason is it's difficult to get lending for these properties. Number two, in my mind, is construction costs have gone up significantly. So it's difficult to build even a Class B and come out ahead on it. It's easier to have wider margins in quote unquote luxury, right? So Class A and even sometimes there's more to it than just it being Class A that deems it as luxury.
Right.
But I think his quote in here, and I think what you were bringing up, Nick, was saying that luxury is just being deemed in part luxury because it's new.
Right, right, exactly, exactly. And this, frankly, shouldn't be a surprise. We see this in all areas of manufacturing, right? I mean, you think about the size of vehicles these days. I don't know about you, but back in the day, my dad had a Silverado. That's all he drove, right? And I remember his Silverado in the 90s, in the early 2000s, was smaller than mid-sized trucks today. I feel like the brand new Chevy Colorado is larger than his full size truck was back then. And it's the same concept, right? If you've got 2.5, 3% margins, if you can build
Right.
it bigger, you can sell it for more, put more money into it, then that 2.5, 3% is going to be more actual dollars than it would be if you were building something smaller, putting less into it, right? It's the same exact concept.
Exactly.
And I think he's
Exactly.
right. I think if, from a developer's perspective or an investor's perspective, we need more incentive to want to, you know, build more affordable housing, right?
Yes.
And we do that to a degree, when we purchase property and we renovate it, whether if we're bringing it up to a B standard, for instance, make it a class B property, those are still relatively affordable than some of these newer, you know, properties that are being built. But we still we have an obligation to our investors and certainly to ourselves to be good stewards of the money that we've invested, right? So it's a difficult sell to not want to do the best that we can.
Yes. Yeah. Agreed. So I do think there's some challenges there. I think one of the challenges that I wanted to highlight from the article, which I'm looking at it here on my screen, is so currently 40% of the cost of multifamily development is in regulation. That's according to Sharon Wilson Gino. She's the president at the National Multifamily Housing Council. So I can tell you firsthand that is accurate in a lot of markets. Not every market, but a lot of markets. In the ones that are struggling with prices the most, it is definitely accurate. So we look at in Austin, Texas, for example, which I lived there for many years. Some of my partners still live there, and we have projects around Austin, but it's at least 40% of the total cost that comes from regulation there. And so that means that you have to do more, or you have to do higher price things, or you have to increase the rent, whatever it is to make the numbers work. Nick and I were just looking at a project yesterday, and we're trying to make the numbers work, right? But because of the regulation for the piece of property, you can only do so many units per acre. And so we couldn't make it work. So we couldn't go with that property because of the regulation. Now, it's not the only reason. We talked about construction costs getting higher, et cetera,
Yep,
right? But it is a huge reason. And I think that people don't quite understand how that all plays in. And you have to be willing to look at what markets are going to balance that out better for you. For us, so far, it's been Houston has been the easiest. Dallas has been second, right? There's other markets, but even when I talk to investors right now, they stay away from the coast. They talk about, man, all this stuff going on in California, it's terrible, right? So they want to come to Texas because regulation is less. Now it's still high and it's still difficult. So yeah, it's a big part of cost when it goes into these evaluations.
certainly, certainly. Joe, we were talking about, I think, a handful of months ago, some of the regulations they've got in Minnesota that have made it
Yes.
difficult to operate. And I think there's a lot of value, or there can be a lot of value in some of the regulations out there. And depending on your beliefs, um, you may agree with me or disagree. But I think when there's too much red tape and things are too complicated, it lowers the incentive to want to add value to those communities, right? At the end of the day, as much as we really want to improve the areas that we operate in, we still have to be good stewards to those that have trusted us with their money, first and
Yes.
foremost.
Yep.
And
That's our number one priority, right?
yep, absolutely, absolutely. And right now, there's opportunity enough in a number of different places that we have the ability to go where we can provide the most benefit and where
Yep.
we can find the most value. So
Yeah. I think Nick too, the time factor there has really, and I see it firsthand working a lot on our development side. We thought we were going to be able to break ground by this date, but it keeps getting pushed back because the city wants something changed or they don't have enough staff or whatever it may be. So the time element increases those costs as well. And that's something you really got to look at as far as how long it's going to take you to get to being able to actually finish the project. You know, and a big piece of that is the permitting and regulation piece.
Time is money. Time is money. And that's
Yeah.
absolutely accurate in those instances. You know, can you imagine if they charged slightly more for their fees, but they were able to cut the time frame down quite a bit? I think that would probably make a lot of benefits for, you know, developers like us, right? You're able
Most of the
to,
developers I know would be happy to pay more upfront if it meant their time was reduced significantly.
absolutely. I
Yeah.
definitely agree. I definitely agree. You know, that article had a number of other interesting quotes in it. I'll leave you with the last one here. I mean, we've talked about luxury, right? We've talked
Hmm.
about rents. We talked about making numbers work. It says, unfortunately, and this is from Al Otero. He's a portfolio manager at Armada ETF Advisors. Unfortunately, I don't think we're going to see rents going down a whole lot over the next 1 to 2 years. Developers cannot make a profit at those more affordable price points. Therefore, we see the development and the new construction at the higher end of the spectrum.
Yeah.
Uh, and that I think that lays it out nicely. That's dead on with our point. On top of all of the reasons we've already discussed, you know, part of the reason rents have been driven higher is that demand has exploded over the last couple of years. We're starting to see it, you know, slow down a little bit. But you know,
You're right.
certainly in COVID, when people were trying to find homes, getting priced out of buying a new home, everybody needs a roof over their head, right? If they're looking to move or do something different, then that's certainly driven up prices, rental prices a bit
It
too.
has. Yeah. The reality is we haven't kept up with building like we've needed to since 2008, 2009.
Right.
And rightfully so that things changed at that point, right? But it changed, in my opinion, a little bit too drastically. And so we haven't been able to keep up. Now, I saw it, I don't know if it was in this article, Nick, but 2022, we built the most apartment units we built in the last 50 years, I think. But guess what happened? Rates went up and now everything's on the decline from a building perspective. So I don't think that's going to stick around. I think 2023, we might have some carryover from that. So it might still be another high year. But 2024, 2025, I think starts are going to be way, way down. And, you know, we're not going to be in a situation where we're looking at oversupply because of the timing of rate hikes and how expensive things have gotten.
Absolutely. I definitely agree. And it's certainly if we see, as you mentioned, if we see rates continue to stay where they are, or
Mhm.
certainly if they continue to increase, I think we're going to see a lot of deceleration in the number of new housing starts. What I'll be curious to see is the number of properties that, you know, were started last year when those come on the market, how that affects, you know, rents as a whole, and whether that can take a good chunk out of demand. But certainly that remains to be seen.
I think it depends on the market there. You know, the Midwest markets, they didn't have as much uh, starting from an inventory perspective. They didn't have as much new construction starting. So I think it's going to be more difficult there. The latest projections I've seen is just rent appreciation is going to go way down. In certain markets, it'll be, you know, pretty low. Other markets will be more stable. But I don't think we're in a situation where we're close to oversupply. I think demand's still there, especially in, you know, we've talked about the numbers for a Dallas or Houston, in the amount of jobs that are still coming and will probably continue to come. So the amount of in migration that we're getting from other states and how that's affecting demand.
I agree. I agree. Only time will tell at this point, you know,
Yeah,
but certainly we can do our
absolutely.
best to try and position ourselves for the future.
That's right. That's what you got to do right now.
I want to move on a bit here. I'm going to share you a little bit about what's in my mug this morning. So I'll show you this beautiful mug we actually made for Mother's Day of 2020. We you know did a we went to a local ceramic shop, bought a
Mhm.
bunch of mugs, taped them up. We painted different sections of it, and they turned out. I think
That's
they turned out
great.
nicely. Yeah, very
Yeah,
clean, very clean. And in
it's
my
a good
cup this
idea.
morning, I've got Pete's Coffee Jubilant Blend. Check it out.
Ah,
Yeah, it's in celebration of Black History Month. So actually, this bag's about. I just opened it a couple days ago, but it's I've had it for about a month. And Joe, you and I got these bags together.
we did. Yeah, we did at the Capital One Cafe in the Domain in Austin, Texas, which is fun fact, where we started having partner meetings as SITG. So, holds a little special place in my heart. But you mentioned that coffee, Nick. I also got it. And the main reason I got it was because it was free. And I like a good deal. So you can't get much better than free. So I enjoyed that coffee as well. Thought it was a really good blend.
I agree. I agree. Yeah, that's my favorite price. Definitely free. Actually, my favorite price would probably be if they paid me to take it, but
Yeah, there you go. That's even better.
no, we're not doing sponsorships quite yet. It's got a great flavor though, it's aromatic, it's got a nice nutty flavor to it. I feel like I taste some notes of Brazil and some fruity
Mhm.
aromas in there. It's a really great medium roast. It sits nicely. Feel like there's almost a sweetness to it, not like an acidic flavor, but I don't know, some sweetness, some honey
Mm.
or cinnamon or something. Anyway, it's got great flavor. I certainly appreciate it. I certainly enjoy it, and I'll be disappointed when this bag's gone because I don't think I'll be able to find another one like it for some time. But we'll see.
I agree with you on all that. I actually already finished mine, so I
Did you
can't
really?
sit here and drink it with you and critique the taste. But it's it's a really good medium roast. If I find it again, I'll likely get it. Depends on the price, of course, but I'll likely get it.
Yeah, the celebration of Black History Month makes it a lot easier to buy, right?
Hey,
But
that's true. Absolutely.
um, well, Joe, yeah, thanks for joining me this morning. We want to talk about what really gets people into investing in real estate. I think, like a lot of things, we all have different drivers. Joe,
Yes.
I think you've got a great story. I would love to hear and share with our listeners how you got into real estate investing.
Yeah, yeah, sure. So back in 2016, my now wife and I, we really wanted to buy a home, but I understood the economics at the time and I knew that, hey, we are likely not going to have enough price appreciation in the amount of time we need. She worked on contracts at the time, so we thought we were only going to be there for a year, 2 years, something like that, right? So I knew that it would be difficult for us just to buy a ready-made home and make any money off of it or even break even once we were ready to sell. So we decided that we were going to figure out the flipping route. So in 2016, we bought a home right around $100,000. We actually found a way to get a loan where you could buy the home and then you could get a loan on top of that to do the renovations. So we bought it for about 100. We put 25,000 into it from a renovation perspective. We did the majority of the work. Now we had help from friends and family that showed us how to do some things like that. But we did the majority of the work ourselves. And when it was all said and done, we had put about $10,000 down to get the property. And when we sold it 2 years later, we waited for that 2 year time frame because then we didn't have to pay capital gains taxes. We made about $50,000 on that property. So we 5x'd our original investment. And that's really what kickstarted us into flipping homes. We started flipping more and more homes and we did really well on them. Our best property was probably no surprise to anybody listening in Austin, Texas. We had a great flip there, bought it right before COVID, lived in it for about 2 years and sold it again. That whole process again, and it worked really well for us. But we also realized that it was a ton of work and we weren't really able to scale the business doing it that way. So that's how I really got connected with my partners at SITG and really got into why it's more beneficial for me to do multifamily investing versus just making money doing single family flips. And on top of that, what's more beneficial about that from a cash flow perspective than just owning several single family homes and trying to make those work in your favor to get you to where you envision yourself as financial freedom. So that's really how we got to the point now where we've scaled and got to us being able to look at properties that are 400 units, sometimes more.
Yeah, that's fantastic. That's fantastic. And Joe, really, it's because of your experiences, that I'm sitting here with you this morning. It's through the lessons that you learned and were able to pass on that I'm here. And I'll tell you, I think our close friend Fred has another great story. We'll have him on the show one of these days, but he and his now wife bought a duplex. Uh, at the time, they renovated one side and lived out of the renovated side while they were still renting out the other side. Uh, while they were living there, they were able to cover many of their construction costs, I believe, and
Mhm.
certainly were able to cover a large chunk of their rent or their mortgage payment with the rent from the other side of the property. So it made living there much easier. They were able to build more equity in the property. And then when they moved out, now they're renting out both sides. That's covering a large chunk of their mortgage payments on their current home as well. So they're able to cover almost two mortgage payments with that one property. And I love hearing Fred talk about how his driver for purchasing that property was that it would provide cash flow in the near and midterm, but long term, he talks about how someday when he has children and they go off to college, they'll be able to either live in one of those, one side of that duplex, if they're going to school locally, or they'll be able to cover a lot of their expenses. Hopefully that property will be paid off by then, and they'll be able to provide cash flow to their child, cover some of their living expenses or student loan expenses with rent payments that come in from that property. And so, his driver is really financial security long term for not
Yeah,
even him and his family, but his children.
sure.
So I think that's fantastic. I think that's fantastic. And I think you touched on, a number of the difficulties of the do-it-yourself route where you
Right.
own family homes or small duplexes.
Well,
Um,
look, I want to be clear because I've done it both ways.
sure,
And for us, investing in larger projects, multifamily projects, and doing it through SITG, as we do, okay, you've got to have more assets to be able to do that. That's
you do.
just plain and simple.
Yep.
50,000 is the minimum, right? So you have to have that. If you're listening to this and you're just starting, you can start like Nick, like I did, like Fred did, with a small property. And there's tons of programs out there, FHA programs, all kinds of programs for you to do a small down payment to get into a property. So there's ways for you to start, with a few $1,000s, $10,000, something like that, where you can get into it. So I don't want to discount it too much, but there's a lot of difficulties with doing it that way.
There are. And, I'll tell you, if you are one of those listeners and you're starting out looking to get into this side of the business, I would encourage you to check out Bigger Pockets. They've
Yeah.
got an entire network community. They've got literature, educational materials, videos, conferences you can go to that teach you how to do it yourself. And it's a great place to learn, make connections, and start your journey into building wealth. And absolutely, if you're looking to do something, you're looking to execute on a property in the next year, I would encourage you to find a good loan officer, a good mortgage loan officer, because there are a number of different opportunities out there to help you buy a property, regardless almost of how much money you have in the bank.
Yeah. And Nick, I think what would be a good exercise is we'll do this in an upcoming episode, is we'll actually bring on Fred, who is a mortgage officer, and we can talk through the specifics of that with him.
Absolutely.
That way you guys can have somebody to reference.
Absolutely. Absolutely. I think that's a great
Yeah.
idea. That's a great idea. But Joe, let's talk about some of the
Yeah.
difficulties that we ran into, For me personally, and maybe for you too, I know you've got some construction experience, but there was an entire skill set that I had to learn, and I'm not even sure I learned all of it, if I'm being
Yeah.
frank. And my wife and I had to become a team, and you know, thankfully she was willing at the time. I think for us, I don't know that there's a do-it-yourself opportunity in the future because we do see the value of scale, but you have to learn a bunch of new skills. If you don't
You
have
do.
those skills and you find difficulty in learning them, then you have to hire it out. Hiring a contractor is going to reduce your potential gains.
Exactly.
Yeah, Joe,
Yeah.
did you run
I
into any?
think,
Yeah, go for it.
no, I think that's the challenge. And you bring up a good point, Nick, because for us, we had to do it ourselves in order to add enough value. At least that's the way that I saw it. So we did have to learn a lot of skills, and it's difficult. I mean, I'm talking, we would work sometimes 14, 15-hour days because we'd get done with our regular jobs, then we'd go work on the house, and we did that for months just to get it to a living standard, right, where we could actually live in the property. So to me, it's a lot of work. Now, are there upsides to it from a financial perspective? Sure. But personally, I only wanted to do that so many times before I thought, you know what, there's got to be a better way, right? So adding value through flipping is great, but it's difficult. And Nick brought up a good point too. If you're going to hire it out, you're going to reduce your margin significantly doing that, especially for some of those easier tasks that you can do on your own. But again, ton of work. So that, and then the managing rental part of it, if you want to hang on to it, is difficult. So it's hard to find a good management company. And even if you do, they're probably going to charge you 10% or so. So it's difficult for you to make money just having one, two single family properties, or even a duplex or a fourplex, and doing it all yourself or hiring out to someone to manage that property.
And if you do it yourself, you have to go through. I mean, there's a lot to it, right? To finding quality tenants, running
Yep.
background checks, doing maintenance yourself, being on call 24/7. There's a lot that goes into it, a lot that
There's a
goes into
lot. And
it. And then if you have oh yeah, go for it.
I was just going to say, I personally only want to be an investor and receive the investor benefits of real estate investing. I don't want to be a property manager. So I don't want to get a call at 3 in the morning saying the water heater broke. I don't want to have to go out and fix something on my day off, those types of things, right? I personally want the benefits of being an investor in real estate.
And that's not to say, that there's still value to be had there, but I know here in Lawrence, where I'm at currently, during COVID, they put rent moratoriums in place, and there
Yes.
were, we have some friends that, a number of friends that own properties that their tenants stopped paying rent, you know, and
Yep.
and there are a variety of reasons on good and bad that rent moratoriums are put into place. But at the end of the day, you as the landlord and as the property owner, you still have bills to pay. And maybe you're not in a position to, certainly if you're just starting out, you may not be able to cover those additional mortgage payments, out of your own pocket. So it can put
Right.
everybody into a bind.
That's
Certainly.
true. Yeah. Yeah. And, I see we talked a little bit about tax problems. Um, and some of that can be from we had an Airbnb for a while, and that was really complicated from a tax perspective. A lot of cities are cracking down on Airbnbs from a tax perspective. So it just depends on what you have there. But yeah, I do think that's also another dynamic that makes it difficult.
It's all about, Joe, you and I talk about this, the law of large numbers. It's
Law of
all
large numbers. Yep.
achieving consistent returns, steady cash flow, and the
Yes.
way to do that is by scale, right? Scaling it up.
Yes. It is difficult to do in the DIY sector, right? Without scale, it's difficult. So, Nick, I think this is a good transition though to talk about then why multifamily, kind of flip that on its head. So why multifamily
Agreed.
takes care of some of those challenges that we talked about that we've personally experienced in the single family or, even just smaller multifamily unit market.
I agree. I agree. Yeah, let's dig into it. And really, I think for the a lot of our investors, right, people who qualify, income can
Mhm.
be a big driver, making
Income's
that
a huge one.
for you.
Yeah. Yeah. So our fund is very easily able to pay out 10% to our investors from a preferred return. So you put in $120,000, for example, you're getting $1,000 every month. And it's really hard to cash flow $1,000 a month on a $120,000 property. That's really, really difficult to do.
If you're doing it yourself.
If you're doing it yourself, exactly, exactly. For the reasons we talked about previously.
Right, right. And Joe, for me, certainly when I first came onto this side of the business, 10% seems like a really high number. But when we dig into the numbers and we look at the scale, you're right, it's very achievable. For our listeners that maybe aren't involved with us, haven't invested with us, can you give us a bit of insight into why 10% is achievable?
Sure.
You've to me, and I think a lot of others would be interested to hear.
Yeah, I mean, I think the key points really are the scale aspect of it. So we can get insurance for significantly cheaper. We can do repairs for significantly cheaper. I'll a couple of examples, right? We knew somebody that owned an apartment complex in College Station, Texas, bought that from them. They were paying $9,000 a month in insurance. We were able to get it for $3,000 a month in insurance.
Boom.
So right there, you've already got additional $6,000 a month in cash flow just from that. Then there's other things too, where you can buy, let's say, paint in scale. You're going to get 30, maybe even 40% discount just doing that. So you go through and you look at a balance sheet and you take all of those things and you add them up. You're very easily able to take a underperforming property and turn it around because you're able to scale and you're able to use those things to your advantage. So you can't really do that in a single family home. You're not going to buy enough paint to get a discount. You're not going to have enough properties to get a discount on insurance or a discount on management or any of those types of things. So scale is really key for us being able to go out there and provide a consistent great return to our investors.
Absolutely. I think that's fantastic. And when we dig into the numbers, scale is found everywhere, as we've
Everywhere.
discussed, right? It's
Yeah,
all over the place. It's the same reason that, Walmart's, or one of the reasons that Walmart's become so successful, because they've
absolutely.
been able to shape the industry to their needs because they're such a heavyweight in that arena.
Right.
Um, Joe,
Right.
one of the other benefits that we see a lot of people do, come to us is we've got a number of clients that have been in the do-it-yourself space and they've decided, you know what,
Mm-hmm.
I'm done managing, ready to get out of it, and I want to do something different. And they come to us because they've got appreciation on the properties they've purchased and they want to delay paying those gains for as long as possible. There's a lot of value in doing a 1031. So
A
we
lot of
see
value. Yeah.
us for that. Yeah, Joe, what other items do you see that maybe I'm
I mean,
missing?
yeah, just for the whole tax shell perspective, I think you have a lot of options there. Nick mentioned 1031. That's a specific gains deferment tool that you can use, but there's a lot of other uh, benefits from a real estate perspective when it comes to taxes, depreciation, things like that that you can do that not only help you from a business perspective, but can help you on an individual perspective as well.
Absolutely, absolutely. And on top of all of this, one of the most basic reasons that I see is diversification. You can diversify
It is.
across
Yeah.
locations, across different price points, different, demographics. you can diversify, and it's got a lower correlation to stock and bond markets than traditional investments do.
It does. Yeah. Yeah. So it's a great piece, and we've talked a little bit about it in some of our previous podcasts, but it's a great piece to add to your overall investment portfolio. The amount that you want to do percentage wise is different depending on who you are. And, Nick and I have financial advisor backgrounds, so we would have to talk you through that specifically, but it's a really great piece for anybody to have because of the diversification aspect of it, because it does not correlate well to the stock market. It has a higher, it has a better risk adjusted rate of return than the stock market, than corporate bonds, than a lot of things that you can go out to the public market and buy.
So what I would say, if you've got additional questions, if some of the items we've said have been intriguing to you this morning, give us a call, shoot us an email,
Please.
check the site, www.sitgcapital.com. We're SITG Capital because we've got skin in the game. We invest alongside our investors. And just as we want to be good advocates for our own dollars, we certainly want to be advocates for your investment as well. We take it very personally that we do a good job and that we perform well for you because we're on the same side of the table as you are. So check out our website. You can send me an email, send Joe an email. We'd be happy to schedule a call and dig into your unique situation and see if maybe there's value we can add.
Yeah, and if I will say too, if you are listening to this, you haven't subscribed, please subscribe so we can get out more educational information. If you've got questions for us, email us questions, or you want us to cover a specific topic, we would love to do that. So let us know what's on your minds. We're here to educate first and foremost. So let us know how we can do that for you.
Excellent. Well, Joe, hey, I appreciate your time this morning. Thanks for meeting with
me. You too, Nick.
Listeners, viewers, thank you for your time, and we'll look to connect with you again next week.
Sounds good.
All right. We'll see you. Take care. Bye-bye.